Most people dream of doubling their money, but very few actually know how long it will take. That's where one simple formula known as the Rule of 72 comes in. It's one of the most powerful tools in personal finance. It's simple, it's fast, and it works like magic once you understand it. So today, let's break down exactly what the Rule of 72 is, how to use it to predict your future wealth, and how small changes in interest rates can dramatically speed up your journey to financial freedom. The Rule of 72 is a simple mental math shortcut that tells you how long it will take your money to double, based on your rate of return. All you have to do is divide 72 by your annual rate of return, and the answer tells you roughly how many years it will take for your investment to double. The formula looks like this. 72 divided by interest rate equals years to double. Let's say you invest your money and earn an 8% return per year. Using the Rule of 72, 72 divided by 8 equals 9 years. That means your money will double roughly every 9 years. Simple, right? But don't underestimate it. This simple rule can change how you think about compounding forever. Let's take a real-world example. Imagine you invest $10,000 in an index fund that averages 8% per year. In 9 years, it becomes $20,000. In another 9 years, it becomes $40,000. Then $80,000 and so on. Without adding any extra money, your $10,000 could become nearly $160,000 in about 36 years, just through the power of compound growth. That's the magic of time and consistent returns. Now here's the exciting part. Let's compare what happens when your rate of return changes slightly. If you earn 6%, the Rule of 72 says, 72 divided by 6 equals 12 years. It takes 12 years for your money to double. If you earn 9%, 72 divided by 9 equals 8 years. Your money doubles in 8 years. That's a 4-year difference just by earning 3% more. It might not sound huge, but over decades, it is massive. Let's do the math. At 6% return, $10,000 doubles every 12 years. After 36 years, it becomes about $80,000. At 9% return, it doubles every 8 years. After 36 years, it becomes about $160,000. That's double the wealth just from earning a slightly better return. This shows how powerful the Rule of 72 really is in helping you visualize your money's growth. Now, let's flip the formula. You can also use it to figure out what rate of return you need to double your money in a certain amount of time. For example, if you want to double your money in 10 years, just divide 72 divided by 10 equals 7.2%. That means you need an average annual return of 7.2% to double your investment in a decade. This is why investors love the Rule of 72. It helps you set realistic goals. You can quickly estimate how much you need to earn and how long it will take. But here's something most people overlook. The Rule of 72 doesn't just apply to investing. It also applies to debt. Yes, the same math that grows your investments can also grow your credit card debt, but in the wrong direction. Let's say you have credit card debt with an 18% interest rate. Using the Rule of 72, 72 divided by 18 equals 4 years. That means your debt will double every 4 years if you don't pay it off. Scary, right? That's why high-interest debt is so dangerous, because the same compound interest that helps investors get rich makes borrowers go broke. Let's talk about why this simple rule works so well. The Rule of 72 is based on the concept of compound interest, which means you earn interest not just on your initial investment, but also on the interest you've already earned. It's like a snowball rolling down a hill. It gets bigger and faster over time. The Rule of 72 gives you a quick way to estimate that growth without complex math. It's not 100% exact. It's an approximation, but for rates of return between 4% and 15%, it's surprisingly accurate. If you want even more accuracy for higher rates, you can adjust the rule slightly, use 69 or 70 instead of 72. But honestly, for most people, 72 is perfect for quick financial planning. Now, here is something most financial advisors never tell you. You can use the Rule of 72 to understand inflation too. Let's say inflation is 3% per year. How long will it take for your money's purchasing power to cut in half? Use the same formula. 72 divided by 3 equals 24 years. That means in 24 years, your money will buy half as much as it does today. If inflation rises to 6%, your money loses half its value in just 12 years. That's why keeping money in a low-interest savings account is dangerous during inflation. If your savings are earning 2%, but inflation is 4%, you're actually losing money in real terms, slowly but surely. So the rule of 72 doesn't just show how to double your wealth. It also shows how fast your money loses power if you do not invest it wisely. Let's look at how wealthy people use this rule strategically. They don't just focus on earning big returns. They focus on earning consistent returns that allow compounding to work over time. A millionaire understands that doubling every 7 to 10 years creates massive results over decades. That's why they invest in assets that grow steadily like index funds, dividend stocks, or real estate instead of chasing get-rich-quick schemes. They know that the rule of 72 rewards patience. Think about it. If you invest $20,000 and double it every 10 years, in 40 years, that becomes $320,000 without ever adding more. But if you keep adding extra money every month, you could easily cross the $1 million mark. That's how ordinary people build extraordinary wealth, not overnight, but over time. Here's a practical way to apply the rule of 72 right now. Look at where your money is sitting. Is it in a savings account earning 1%? 72 divided by 1 equals 72 years. It will take 72 years to double. That means if you put $10,000 in the bank at 1%, you'll get $20,000 by the time your great-grandkids retire. That's not growth, that's stagnation. But if you invest that same $10,000 in an index fund averaging 8%, you will double it every 9 years and your money starts working for you instead of sitting still. Here's another cool thing. You can use the rule of 72 to compare investment options. For example, say one opportunity offers 6% and another offers 10%. At 6%, your money doubles every 12 years. At 10%, every 7.2 years. That's nearly 5 years faster, which means more compounding cycles and significantly more wealth long-term. It helps you understand risk versus reward better and see whether a slightly higher return is worth the potential volatility. Let's recap how you can use the rule of 72 in your financial life. Use it to estimate how fast your investments will grow. Use it to see how quickly debt can spiral. Use it to understand inflation's impact on your savings. And most importantly, use it to make smarter long-term financial decisions. Because when you see how time and interest work together, you stop chasing luck and start building strategy. Money doesn't grow because you hope it will. It grows because of compound interest, and time is your greatest ally. The rule of 72 helps you visualize that growth instantly. It turns complicated finance into simple, actionable insight. Whether you are investing for retirement, saving for your kids, or paying off debt, understanding the rule of 72 gives you control. Because once you know how long it takes to double your money, you can plan how to double your life goals. Don't let your money sit idle. Make it work. Start now because every year you wait is another year you could have been doubling your wealth. If this opened your eyes, make sure to like this video, subscribe for more financial wisdom, and share it with someone who needs to start investing smarter. Remember, wealth isn't built overnight, it's built through knowledge, consistency, and time. And now that you know the rule of 72, you hold one of the simplest yet most powerful financial secrets in the world.